page, you'll see the other world markets, and you have Australia, Brazil. So Brazil is one of the BRICS, the Brazil, Russia, India, and China, and it's down from a year ago, and it's down from 2 years ago, and it's down from 7 years ago. Australia is much more noticeable. France is getting perilously close, especially, this doesn't include today. France got whacked hard today after the election. It's getting perilously close to the 2009 crisis low. And then this is Germany over here, down from a year and down from 3 years. Down from 5 years, excuse me. Okay, over on the next one you have Hong Kong. This is India over here. You don't tell it from the title. But it's another of the BRICS, and again down for over the last couple of years and down from 2007. London and Milan, the Italian index, that, as you're probably not surprised, is down here virtually at the level of its 2009 crisis low. Next page shows you the Netherlands, Russia, Shanghai. All right, this is important. This is the Chinese index. Obviously another of the BRICS, but what's particularly important is that China, as we've all heard incessantly over the last several years, is supposed to be the engine of world growth. China is down today from a year ago, from 2 years ago, from 3 years ago, from 4 years ago, from 5 years ago. China, for some reason, and China is 60% below where it was in the 2007 market, at the market peak. Something's wrong there. We hear all these great numbers out of China. People who are investing in the stock market tend not to believe that they're as great as they may be in the newspapers. The next page is the last page of these. It shows South Korea, Switzerland, Taiwan, and Tokyo. Tokyo, likewise, another giant market. As I mentioned, at the end of the 1980s was the biggest market in the world. It's not too far above its 2009 lows as well. With all of the obvious problems around the world, investors are increasingly asking where they can get yield. That quest for yield is seen very clearly in the next page, and we'll turn our attention a little bit here to fixed income. This shows how investors have come to love bonds. This goes all the way back to 1950 approximately. It's interesting, and this shows you, it's again a ratio, this shows household bonds as a percent of disposable personal income. And there are a couple of interesting observations. Almost by comparison, certainly, nobody owned bonds down here in the late 70s and early 80s. Interest rates on government and high-grade bonds were in the upper teens. I'm sure in some of the corporates you snuck a few over 20. But very few people owned them. There was great fear at that time. Conversely, here we have everybody owning them, and the 10-year U.S. Treasury yield at the close today was 1.84%. So it's an interesting study. Down here, when they were yielding tremendous yields, nobody wanted them. Up here, where the yields are not even as high as the rate of inflation, everybody seems to want them. More and more money is being poured into bonds over the last few years. It's been a remarkable phenomenon. They've done well. I mean, bonds, because they are near their all-time lows, anybody who's gone into bonds over that time period, I mean, unless they've selected poor individual bonds, in general have made money. Not huge money if they're in relatively conservative stuff, but some very big money if they took a lot of risk. For example, and I just read this, I didn't measure it, but the long zero coupon treasury last year earned 80%. according to one writer, which I read this week. As I say, I didn't measure that, don't know for sure, but if you're willing to take the risk, there's return out there. And even if interest rates stay low for a while, and there's certainly no guarantee of that, many of these bondholders will suffer losses in their bond holdings, because it's not likely that they're going to stay down here indefinitely. When rates rise, bond prices decline. And you can say, well, of course, we can always hold the bonds to maturity, and that's true. And let's say you buy a 10-year U.S. Treasury today and you hold it for 10 years, you will have gotten 1.84% every year. Now, what that aggregate amount of money that you get back, including your interest, will buy you over the span of those 10 years, I don't know. And that's one of the big questions that we face economically. We don't know what our currency is going to buy us in the years to come. We don't know how markets are going to react to this flood of money that is coming from all the major central banks of the world. There's one of the questions that comes up now, and I wrote a piece on my blog a week and a half ago saying beware of chasing yield, and it was written in response to two friends who said, what can I do to get more yield? And I said, well, we can always get you more yield. It's not hard to get more yield. And I used and by the way, this piece is out on the table for those who are interested, and I suggest it's a piece that's well worth reading. Most people are thinking, how can I get more yield? And I suggest many people will make some very bad decisions that will cost quite a bit of money over the next several years in going after certain things that appear to be attractive yield right now. But I used the example in the paper. I said, I could have, just a little while ago, I could have gotten you a 100% return on a one-year government bond. A one-year government bond. That was the promised return. Unfortunately, the government was Greece just before the recent default. And I tried to make the point in there that the bond market around the world is a gigantic market. It's far, far bigger than the world's equity markets. And there is no free lunch. Don't think you have found the precious little nugget that's been overlooked by the rest of the world. There is a very clear relationship between yield and risk. If the yield today is above average, I can guarantee you the risk is above average. You may not appreciate what the risk might be, but the wealthiest people in the world and the institutions with the greatest amount of money are searching the world for yield. If you find the little nugget, it's not that they make good decisions all the time, not by any means, but it isn't because it's unknown, unless it's a private deal or something or other like that. But even there, nobody gives you more money to sell what they need to sell than they have to. They're not doing this out of largesse. So if you find a higher yield, I can promise you, you're assuming a higher level of risk. I talked in the paper, and I won't go through it now, but I would suggest you take a look. I tried to address the major areas where people are looking for yield. Most don't look in the equity area. Those that do tend to look at utilities as the main area. And utilities can be very productive, very good, but it's important to note that utilities, like almost every other risk-bearing asset, have periods where they do particularly badly. And it was not too long ago that utilities fell from, I forget, it was about 60% back in 2000 to about 2002. So admittedly, a lot of other things were getting beaten up, but utilities, supposedly a very conservative yield-producing vehicle, was beaten down worse than most, about 60% peak to trough in that 2002 period. And then we had another 50% decline in utilities in 2008. So they're not without volatility and risk. And you can say, well, today they've bounced back. And yes, it's true.